Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, solo 401k masterclass. So if you give me the next 30 minutes, I will teach you everything you need to know about the solo 401k plan. I'm going to go through eligibility. What is a solo plan? How is it different than a regular 401k plan? Talk about some of the advantages. Talk about some of the compliance requirements and kind of summarize why I think it is the best retirement plan for the self-employed. Okay, so let's get started. It's going to be fun. I'm going to try to keep it around 30 minutes. I know everyone has a lot to do, and after about 30 minutes, hearing me talk about retirement plans probably not the most enjoyable thing. So I'll keep it short, but I'll give you, I promise, everything you need to know. Here's a little bit about me. Obviously, I'm Adam. I've written 8 books on retirement plans, and I also have written 2 books on the solo 401k plan. You can ask my wife. I don't know a lot about much else other than self-directed IRAs and solos. I don't think there's probably anyone in the country that knows more about this stuff than me. It's just the truth. I have a law degree, I have a master's in tax law. I've worked at some of the largest law firms in the world for almost 9 years. So I would put up my experience against anyone. And it's what I love to do is kind of just provide content, educate people. There needs to be a lot more solo 401k plans set up, whether you set them up through IRA Financial or Schwab or Vanguard, I don't care. It's more important to take advantage of the power of this plan. This is an unbelievable, robust, and powerful retirement plan. And on this video, I'm going to teach you why it is. Okay, so what is a solo 401k? It's not a new type of plan. When ERISA was created in 1974, it created a 401k plan. Okay, the solo 401k plan was created at the same time a regular 401k plan was created. They're both defined contribution plans. The only difference is with a solo plan, you're technically not subject to ERISA. What's ERISA? It's the rules that created IRAs and 401ks, along with a lot of other very complex rules that govern these types of retirement plans, but more specifically are there and focused on protecting non-owner employees. But in the case of a solo 401k, as the name suggests, it is a 401k plan where there's no non-owner employees. Okay, so there's no one to protect. ERISA doesn't need to protect anyone because it's only the owners, and the owners obviously can protect themselves. So the solo plan was really designed for someone who's self-employed, and I'll get into eligibility in 1 minute. The name solo 401k is not a legal term. Okay, you can call it anything you want. 401k, individual 401k, self 401k, Adam 401k, doesn't matter. It's like the word self-directed IRA. It's not a legal term. You will not find the word solo 401k in section 401 of the tax code. Okay, the IRS refers to it in multiple fashions, whether it's self-employed 401k or individual 401k or solo 401k. So don't get so caught up on the actual name. The mechanics of the plan are more important, and more specifically, the advantages of the plan. Okay, so let's just really quickly get into eligibility. It's pretty simple. There's 2 eligibility requirements. Okay, number 1, you got to have a business, right? Only a business can set up a 401k. Now, the business doesn't have to be YouTube or Google or Apple or Tesla. It could be anything. It could be sell shoes on eBay. It could be a math tutor, a consultant, a lawyer, an accountant, a doctor, real estate agent, Uber driver. Doesn't matter, right? You get to either provide a service, sell a widget. That's what a business is. Now, business kind of know it when you see it or you're in it. Like my kids do stuff on the side. They trade, cards and sell shoes here and there, maybe to their friends. Or one of my friends, my son's friends, he sells V-Bucks for Fortnite. That's not a business, right? He's making, $100 here, $20 there. That's not a business, right? He's no expenses. He's just kind of side hustle. It could be a business if he files a Schedule C, but his intent is not to be in business. Okay, so that's the first eligibility requirement, U.S. business. But again, it could be a side business. It doesn't have to be your full-time job. You could be an executive at Apple, and on the side, you do some consulting, or I don't know. I have a client that's Santa Claus, right? For a month and a half a year, he sits in a mall or somewhere, and he makes like $3,500. He's a retired guy, but he likes it, and he's self-employed. So he has a solo 401k. not necessarily to shelter the $3,500, but more to use it as an investment vehicle, which I'll explain momentarily. So it could be a side gig, it could be your full-time gig. Number one, it's got to be a business. Number two, there cannot be any full-time employees, and full-time means 1,000 hours or 3 consecutive years of 500 hours or more. So 1,000 hours or 3 consecutive years of 500 hours or more, okay? And can't be a owner or a spouse. So spouses are not treated as employees. If your spouse works 1,000,000 hours a year, it's not, he or she is not an employee. So you can have a situation where you own 100% of your business and your husband or wife is an employee, and you can still do a solo 401k because a spouse under ERISA is not defined, as an employee for eligibility purposes. So you have to have a U.S. business, and number two, no full-time employees other than the owners of their spouses. That's it. Okay, it could be a side gig. You could, as I mentioned, do DoorDash deliveries here and there, Uber, or Lyft, whatever. You just need to have some business income, and obviously you need to want to do this, right? The whole idea is the IRS is very, very committed to the fact that a 401k plan should be a permanent type of exercise, meaning when you set up a solo 401k plan, it should be something that's permanent. It's not for today or this year. It should be for many, many, many years. So they want to encourage folks to set up a 401k. And to that end, what they've done recently under the Secure Act 2.0 is there's something called an auto enrollment credit. Okay. And this should probably only be relegated, I should say, to companies that have employees, that have non-owner employees, non-highly compensated employees that make less than 150K and are not owners. But this little peculiar auto enrollment credit will allow you, if you set up a plan, $1,500 tax credit over 3 years. So $500 tax credit each year for 3 years, which basically means you get the 401k plan for free and a bunch of annual admin. It's kind of a little bit of a quirk in the rules. I'm not sure that's what the folks on the Ways and Means Committee, the Senate Finance Committee, and ultimately, the president, when he signed the bill, don't think they actually thought that through. But it's a nice gift that if you're setting up a solo K, you'll literally get a $1,500 tax credit, and a tax credit is super valuable. It's a lot more valuable than a deduction, because a deduction just reduces the amount, the tax liability, the taxable income. So if you have 100K and you have a $20,000 tax deduction, pay tax on 80K. A credit is dollar for dollar reduction of tax liability. So if you owe 25K to the IRS and you have a $10,000 credit, you only owe $15,000 to the IRS. So a lot more impactful. What businesses can set up a solo? Anything. Again, you just need to satisfy those eligibility requirements. Get out of a business and no full-time employees other than the owners of their spouses. It could be a sole proprietor, single member LC, C Corp, S Corp, partnership, charity. As long as there's a business, it could set it up. Plus satisfy, obviously, the eligibility. Let's talk about the advantages, okay? The primary advantage of why people set up a solo plan over a SEP, over a traditional or Roth IRA, is the contribution limits, okay? 2024, you can put away 23K if you're under 50, 30,500 if you're over 50. That's dollar for dollar. That could be in pre-tax or Roth, okay? That's the first bucket. The second bucket is the profit sharing contribution, which is an employer contribution, also can now be done pre-tax or Roth, okay? And when you put those, and it's 20% if you're a sole proprietor or single member LC, 20% of your net Schedule C. And if you're a W-2, C Corp, S Corp, it's 25% of your W-2. So when you add the employee deferral of the 23 or the 30,500 if you're over 50, and you add that profit sharing of the 20 or 25%, you add them together, you can't go above 69K if you're under 50 or 76.5 if you're over 50. So simple example, sole proprietor, 45 years old, make 100K, Schedule C. SEP IRA is a pure profit sharing plan. It's only let you going to do 20,000, 20% of 100. Solo K will let you do 23,000 plus 20% of 100 or 43. They'll let you double it up. Now, SEP IRAs don't have a catch up. So that means if you're over 50, you still can only do the 69,000 max, right? There's no $7,500 catch up. So let's say you're over 50. Let's say you're 60, you make 100K W-2. You have a SEP IRA, you can do 25 of 100, 25K. If you have a solo K, you'd be able to do 30,500 plus 25K giving you $55,500. Pretty good, right? Double what you could in a SEP. So now starting in 23, the employer profit sharing can be pre-tax or Roth. In both cases, the employer will get that deduction for actually giving the participant the contribution. In the case of the Roth, it's just something to keep in mind. You actually have to pay tax on that money because with a Roth, we know it's after tax. So if they didn't tax you today on that grant of the profit sharing contribution and you were over 59 and a half and the Roth was open 5 years, they would never capture the tax because the Roth would be able to be pulled out of the plan tax free. So they got to capture it now. So that's just something you need to keep in mind, that if you elect to do a Roth employer contribution, you're going to have to pay tax on what you get. Whereas if it's pre-tax, since you pay tax when you pull it out down the road, the company still gets a deduction, but you don't pay the tax on that contribution. So cases now, pre-tax and Roth, employee deferrals and employer. So this is the primary reason why you should do a solo K. It's all based off deferral. And I've said this, for years. I repeat on every video I do. The retirement system is rigged in our favor. Okay, it is. Why? It's based off deferral, compounded returns. Albert Einstein stated clearly, compounding returns is the eighth wonder of the world. Warren Buffett, Charlie Munger, they've repeated that consistently. Your money grows faster when it doesn't pay tax. It's simple, right? My 10-year-old kid figured that one out. 8% rate of return. If you average that over 8 years, you'll double your money every 8 years. Okay. The IRA, Roth IRA, other than life insurance, is the best way to take advantage of the power of compounded returns. That's why smart people save in a retirement account. And if you're self-employed, if you're watching this video, even if you have a little bit of income, this plan could end up being a difference for you. So let's do some examples here. Okay. So let's say you work at Apple and you max out your 401k, right? You probably are a pretty smart guy or gal. And the way the employee deferrals work is once you hit the 23 or the 30,500, that's a per individual. So even if you have 10 jobs, once you hit 23 or 35, if you're over 50, that's it. You can't do more. You can't double dip. But on the employer profit sharing, and we'll get to the mega backdoor also soon, that is per business. So even if you max out of the Apple plan, if you got another business that does, let's say, $50,000 of net profits on a Schedule C, you can do 20% of 50. That's an extra 10K that you can dump in and get a deduction for it. Now, obviously, if you do it one-off, not so exciting, but if you do that for the next 7, 8, 10 years, that 80 or 100K of contributions will be worth 2, 3, 400 grand over a period of years, depending on what you invest in and depending on how patient you are. So every dollar matters. It's just time value of money. It's compounded returns. The key is, just starting, good habits, and trusting the process. Just being patient and let the math work for you, and it will. Okay, so that's something that people don't really understand, and that's what I'm kind of here to explain is even if you have a full-time job and you're maxing out, or maybe you're not maxing out, maybe there's some leftover money to be deferred. If you have a side business, even if it's not your full-time gig, you can still do a solo plan for that side gig, even if you are an executive or have a 401k at a different job. So that's something to keep in mind. Very important. Okay, the contribution deadline. So we're in 2024. 23, we're focused. The 23 taxable year is done. But guess what? You can still make contributions for 2023 in 2024. In fact, you can even set up a 401k in 24 for the 23 year, so long as you haven't followed your tax return, including extension, for the 23 year. So if you're a sole proprietor or a single member LLC, thanks to the Secure Act 2.0, you can now do employee deferrals and profit sharing for the 2023 year, even if you haven't set up a 401k in 23, up until April 15th or October 15th with extension. If you have a W-2, C Corp, S Corp, or a partnership with a guaranteed payment, it's a little bit different. Your W-2 technically should have been done 12/31, but you still have that employer profit sharing juice where you can set up a plan in 24 for the 23 year and do the employer profit sharing, that 25% of the W-2 up until the corp or partnership files its return, whether it's March 15th for S Corps or partnerships, September 15th with extension, or if it's April 15th for a C Corp, October 15th with extension. So keep in mind, just because you're watching this video in 24, you don't have to say, shucks, I missed 23, it's over. No, that's not the case. You can still take advantage of an enormous amount of potential deductions for the 23 year, even if you have not set up your plan in 23 and you're sitting now in 2024. Now, what are the contributions for 2023? A little bit less than 24, but around the same. You know, it's 22,500 or 30K if you're over 50. The max is 66 instead of 69. And if you're over 50, 73.5 instead of 76.5. So that's available. So please, 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 if you haven't already, you should be discussing these opportunities with your tax advisor. You can always call us. We have an amazing team of tax professionals, or chat us or email us, whatever works for you. And we can help you. We also have a calculator on our website that will go through exactly what you can contribute. You just really have to pop in your income, and it's going to tell you exactly what you can put in. So it's quite simple. And you know, the beauty of IRA Financial is we don't just set up your plan. Like, we'll guide you, we'll help you design it, we'll help you administer it, record keep it, do all the tax reporting. In fact, even if you have UBIT, which we'll get to, we'll file the 990T. Like, we are here to help. And you know, there's no one better at this stuff, personally, in my opinion, than us. So 23, even though it's over, it's not over for your potential contributions and potential deductions. Okay. So I talked about 401k, the deadline. Let's go again. I skipped ahead here. Let's talk about tax advantages. So one of the key tax advantages, obviously, whether you're doing an IRA or 401k, is tax deferral or tax-free growth. If it's a Roth, right? That's why it's smarter to save in a retirement account than just saving in a good old savings account at your local bank. That's why IRAs and 401ks were created by the government in 1974, is to incentivize us to save. And that's why I keep saying that the system is rigged in our favor. It is. Why? Because we're lazy. And the government basically said, we have to really incentivize these lazy Americans, because if they don't, they're never going to save. They're just going to spend all their money, and then they're going to rely on us for Social Security. And oh my God, what happens if Social Security is not around in 20 or 30 years, God forbid? We're going to have a big problem on our hands. So let's incentivize them to save. How did they do that? Well, they created a tax deduction for IRAs, and they also created deferrals, meaning your money grows without tax, right? That's what I talked about, compounding returns. And then they created a Roth in 1997 and basically said, okay, for those that don't want a deduction, you can always jump into the Roth. And so long as you're 59 and a half and the Roth's been open 5 years, it's all tax-free. You can literally take tax-free Roth distributions. Live for free. Also with a solo K, and not all plans are the same. Okay, this is a very important distinction. If you get a solo plan at Schwab or Vanguard, they may give you the plan for free. They may not give you Roth contributions. They're definitely not going to let you do checkbook control alternative assets. They're going to make you buy the products they sell, which is their right. They're not going to give you the mega backdoor Roth, which we'll get to. Okay, and they're also not going to do any of the administration. They're not going to file the 5500 EZs. They're not going to help you 1099Rs. They're literally not going to do much except give you plan documents and say good luck. Okay, so when you put all this together and you get control, you can do checkbook control, you can do alternative assets, you get the loan feature, you get the mega backdoor. That's why I think the IRA Financial plan is so attractive to so many people, is because not only do we have this plan with all these features, but we do everything for you. So kind of like your third-party administrator, you don't need to kind of figure this stuff out on your own. Whereas if you go to a traditional brokerage firm, that's kind of what they're going to make you do. Okay, so let's talk about the solo K loan, because it's a very unique feature to the 401k. With an IRA, you can't borrow $1. You can do a 60-day in-kind distribution once every 12 months, but you got to return those funds within 60 days. With a solo K, you can borrow $50,000 or 50% of your account value, whatever's less. Use it for any purpose. Pay off medical bills, credit card bills, go to Hawaii, buy me a present, whatever you want. You got to pay back over 5 years, at least quarterly. It's a straight line loan. Now, we're sitting now, it's February 8th, 2024. The prime rate, which is the lowest rate you can charge, is 8.5%. Some people say, well, That's a lot. And that is much higher than during COVID, it was 3.5%. And that's obviously much higher. So that means there's greater interest that you have to pay back. But remember, you're paying yourself back. You're not paying a credit card company back, not paying a bank, paying yourself back. And to that extent, you're guaranteeing your plan an 8.5% rate of return, right? If you borrow $50K, you got to pay interest at 8.5%. That means that $50,000 is generating 8.5% rate of return. Now, remember my whole example of compounding returns. 8 years, 8%, you're going to double your money. Here, you're 8.5% over 5 years. So you're more than halfway there. 8.5% is not bad, right? I mean, last year, the S&P 500 was over 20%. It was a great year, but the year before was flat. I think if you ask most people and say, hey, would you take 8.5% rate of return every year for the next 10 years? I mean, I would sign up right away. I think just it's a no-brainer. So you get tax-free use of it. You can use it anytime you want for anything. You can do unlimited loans, but you can't go above $50,000 or 50%. But as you pay back that money, you can start taking out more. And that's something we'll assist you with. We have even a calculator on our website, but our team of tax professionals will assist you and determine exactly what you can take and kind of how it works. This is huge, okay? If you are a real estate investor, listen up. The solo 401k has a secret weapon for you, okay? It's called using leverage tax-free. Now, what's leverage? It's a loan. Every real estate investor can tell you, you always use other people's money, OPM, other people's money. No real estate investor or developer uses cash to buy anything. You're stupid if you do. The tax code isn't designed to encourage you to do that because you get deductions for paying off interest and you get depreciation and you want to generate as much deductions as you can. So using leverage allows you to buy more and gives you greater tax attributes. The thing with an IRA or 401k is, number one, the loan has to be non-recourse. That's not my rule. That's 4975C. The Internal Revenue Code says you cannot personally guarantee an obligation of your retirement account. That's why the loan must be non-recourse. Non-recourse loan is a loan you do not personally guarantee. So obviously, in that case, the lender takes more risk. He's going to make you put down more money, generally minimum 30, 35%. And the interest rate will be a bit higher on a non-recourse loan. Why? Because there's greater risk, right? The only recourse the lender has if you stop paying is they take the property back. There's no personal guarantee. They can't go after your personal assets. So there's greater risk of default and greater uncertainty. So that's why they ask for more equity down and obviously a bit of a higher interest rate. But if you can make the non-recourse loan work, and we have a number of lenders that we work with, then, hey, with a 401k, because Section 514C9 allows 401ks to be exempted from paying UBTI tax, unrelated business taxable income tax, which an IRA would be subject to. So if an IRA did the same deal as a 401k, put 100K in and borrowed 100K from a bank non-recourse, bought the asset for 200 and sold it for 300, that $100,000 of gain, 50% of it would be subject to the UBIT tax, which is approximately 37%. So that's a big tax. Now, if that retirement investor, instead of using an IRA, did it in a 401k, the 100K would go back to the 401k tax-free because Section 514C9 exempts a 401k from UBIT. So it's a massive win for real estate investors. It's the ultimate prize. So I have a lot of clients that are real estate investors that do everything in their power to get into a solo K. And sometimes it works because they have like a side gig or management services that they move from Schedule E to Schedule C and they can make it work. Sometimes, unfortunately, it just doesn't. And then we have to get into some strategies with an IRA to block UBIT, which, you know what, I'll do another masterclass on that down the road. Save that topic for another day. But there are ways to limit, in some cases, even eliminate the bite of the UBIT tax, okay? Now, the mega Roth, to me, I'm a Rother. I'm proud to admit I love the Roth. Some folks don't love Roth. I have some mentors of mine that I love dearly that say, hey, I don't know what's going to happen in 20, 30, or 40 years with the government. Look, in 1981, Social Security was tax-free. They just changed the rules on us. Could they do that with Roth? in 5, 10, 15, 20, 30 years? Could they just say, you know what, we're going to cap Roth, or we're just going to get rid of Roth, and you just have to take the money now, and sorry. Yeah, I mean, who knows what happens in the future? But my bet is the deduction's great. Listen, if you can get $20,000, $30,000 in deduction, that's awesome. For an IRA, it's only $7,000 or $8,000 if you're over 50. So, let's say you're in a 20% tax bracket. The deduction's only 20% of 7 or 20% of 8. And even in a 401k, it's 20% of maybe 20. So, it's 3, 4, or 5 grand, whatever it is. That's real. And no disrespect. I get into this discussion with my CPA every year. But my bet is that over the next 30 years, I'm going to be able to generate more returns than the deduction will save me. And I want those returns tax-free. So I put all my money in Roth, my 401ks, all my IRAs. I've converted prior rollovers. I max out my 401k at work in Roth. And if I could, I would do this mega backdoor. Now, the mega backdoor is a strategy that really only works with solos. There are some type of 401k plans, larger plans that offer it, and it potentially could work, although it's much more difficult because this is subject to certain top-heavy testing and ADP, deferral percentage testing, which only relates to plans that have employees. But because of this mega backdoor, it unfortunately involves this test as well. So if you work at a company with 10, 15, 50 employees, depending on the plan is structured, if not enough rank and file employees that make less than 150 are doing this, the plan's not going to be able to offer it. And I give them this example multiple times. I actually have a buddy of mine who signed up for a mega backdoor because their employer offered it, and he actually had to get the money back because they turned out they failed the test because not enough people did it. So this is literally dollar for dollar. So let's say you work at Apple, you max out your 401k, right? 23. Now you have a side gig of like 30K and you don't really care about deductions. You can literally almost put all of it, $30,000 into the mega backdoor, dollar for dollar. Even though you maxed out, the employee deferral is a different bucket than the mega backdoor. So there's essentially 3 buckets in a 401k. Employee deferral, profit sharing, and the mega backdoor. So it's its own little separate bucket. So you can literally go dollar for dollar, 69 or 76.5. In 2023, you could still do the mega backdoor in 24 for the 23 year, so long as you haven't filed your return. So let's say you're like, you know what, I don't care about deductions for 23, but I got all this extra cash line over. I'll dump it into the mega backdoor. I'd rather save in a Roth because this way I don't pay any tax on the gains, right? Whether you're buying Tesla stock, real estate, cryptos, gold, whatever. Wouldn't you rather invest in a Roth? So if you sell the asset for a gain, you don't have to worry about short-term capital gains, long-term capital gains, ordinary income. It's all tax-free. It all goes back to the Roth tax-free. So that's what smart people do. If they got a bundle of cash, they'd rather save in a Roth or even a traditional because the income and gains in that retirement account is not subject to tax. So it makes a lot more sense to save in a Roth or an IRA or a 401k than it is in a personal savings account. And doing the mega backdoor is the ultimate prize. So our solo K will provide it. If you get a plan from Fidelity or Schwab, it's not going to give it to you. Ours does. There's so many amazing strategies with the mega backdoor. If you're a client of IRA Financial, you probably know about them. If you're not, you should be, and we'll help you through this. But yeah, imagine being able to push another 10, 15, 20, or maybe 60K a year in a Roth. Just do the math. It'll blow you away. I mean, you literally could have millions of dollars more tax-free. And that money may be sitting in your bank account, like literally doing nothing, but getting money market or whatever, and you're paying tax on all that income. And you could do the same investment in a Roth and never pay tax. Just wait till you're 59.5 and pull it out tax-free. Got to be crazy. Easy admin, solo Ks. If you have less than 250K, there's nothing you need to do. But you know what? If you're a client of IRA Financial, who cares? We do it all for you. We follow the 5500 EZ, which is pretty easy. If you do conversions, take distributions, we'll do the 1099R. If you have UBIT, maybe it's not real estate financing, which is exempt from UBIT. Maybe you're investing in a business that triggers UBIT or a fund. We'll follow the 990T for you. so long as you're part of our compliance service. So we handle everything, as I mentioned, the plan design, admin, record keeping, tax reporting. It's a one-stop shop. No one else does it. So the best thing is we're aligned with you, right? We're not trying to sell you products. In fact, we can't. We're not trying to sell you stocks or mutual funds or bonds or real estate or deals. That's not our gig. Our gig is the plan documents. We're the experts. We don't just give you and design a plan, but we'll be there for you for the admin, the record keeping, and all the consulting, which I think is super, super important. Credit protection is better than an IRA, unlimited in bankruptcy. Outside of bankruptcy, most states will give a 401k way better asset and credit protection than an IRA. So just another advantage. And then obviously IRA Financial, just simply we're the best in that. But we literally wrote the book on this stuff. I've written 2 books on the solo K. I don't think anyone knows this stuff better than we do. And most importantly, we don't just set up a plan and say, here's your plan, Joe or Jane, good luck. Just pay us every year for nothing. No. Oh, you have a tough question? Go hire an accountant or a lawyer. We don't do that. No, we will do everything. We will research. We will get you the answer. We will do the record keeping, the admin, the tax filings, the 5500 EZs, the 1099Rs, the 990Ts. We do it all. Okay. You don't have to do anything. We handle everything for you. It's all in our package. Flat fees. We have no transaction fees, asset valuation fees, no wire fees. We'll even open a bank account for you at Capital One. There's really no one better. Plus, you get the consulting, which this is really, in my opinion, the most important factor of why IRA Financial is the best and what separates us is, I have competitors that call me for questions. This is what we focus on. I'm a tax lawyer. I spent hours a day training my team. In some cases, they're smarter than me. But this is what we do. Whereas if you go to some other companies, they'll give you a great plan with an IRS opinion letter, but any questions they're not going to know. They're just going to say, you know what, we can't help you. Go talk to an advisor, attorney, CPA. We don't do that. We'll give you every potential answer that's available. We'll research it for you and get you the right answer. So I think that's the most important thing. Other than now, it's a great time to do a plan because you get the credit, right? $1,500 tax credit over 3 years, literally set up a plan for free. So I got a couple questions. Let me just get to them and I'll let you guys on your way. I told you to stick to about 30 minutes. That's what I try to do. I respect your time. I know there's a lot of other stuff to do during the day. Okay, Faith. Fully in Mega Roth Solo K, can all 66 come from employee post-tax? Yeah. So as long as you have a W-2 of at least 66K, it's its own bucket. So it's not, you don't have to consider it an employee deferral or profit sharing. It's literally dollar for dollar. And as long as you have that in income, you can dump it onto the Roth. You don't get the deduction, but if you're a Roth lover like myself, it's amazing. Okay, Bob, will the tax code allow a solo K custodian to distribute the RMD directly from the 401k cash account via qualified, I can't read that, domestic order, directly to a qualified, or for a charity, the charity. So generally what you would do, Bob, is you'd move it from the 401k to the IRA, and then IRA would do this $100,000 exemption. Sorry, I don't have my glasses on. 401ks technically don't have this exemption. It should come, but it's not there. So what you do is, since you're over 59 and a half, you have a plan triggering event. You literally just move the money from the 401k to the IRA, and you can do what you want to do out of the IRA up to 100K. I think you have to be at least 72. It should be 73. They have to move those rules. But you can satisfy your RMD up to 100K and just give the money to charity. So you just move it, Bob, from the 401k to the IRA. If the solo 401k investments do not have sufficient liquidity to provide for an RMD, what is the best solution? Okay, great question. So you have a couple options. You can take a part of the in-kind asset as an RMD. So if it's an LLC interest, you can take a percentage of the LLC interest, real estate, a percentage of real estate, percentage of stock, right? Whatever it is, you can take in-kind. You just need to get it valued, and you can satisfy the RMD through in-kind. It doesn't actually have to be dollars, cash. It just has to satisfy the RMD amount, and it can be done through cash or in-kind. So, Bob, thank you for that question. Thank you for everyone who participated, everyone who spent some time with me today. I hope you guys enjoyed the masterclass. This is everything you need to know about the solo. If you've watched this video, hopefully I was to the point, clear, succinct. If I wasn't, I'm sorry. I've been doing this a while. Sometimes I do talk too fast. It's not because I want to be done with it. I just get so excited. I love this stuff. I can do hours and hours of this content because I believe in it. This is literally the way you get rich. And it's not a zero-sum game, right? We all can do it. It's not like, oh, only 30% of Americans can get rich in a retirement account. No, we all can do it. It's based on math. We just aren't educated enough. And I give this example, and I'll repeat it. I'm pretty educated dude. I can ask my parents how much they spent on education. Obviously, college degree, law school degree, and I did an extra year, master's in tax law, top law schools, and worked at some of the top law firms in the world. And I didn't know about self-directed IRAs and solo 401ks. So how the heck can we expect everyone else who's just trying to get through their life and work and have other skills? My skill set was a tax lawyer. You asked me to be an engineer, a doctor, an astronaut. I can't do it. I know this stuff, okay? But how do you expect folks that aren't tax lawyers, that aren't focused on this material, to be so educated? And this is literally worth millions of dollars. This content is worth millions of dollars. It is. I've seen it. It's just understanding the rules, maximizing how the rules are structured, and they're not hard. You just got to understand them, and then literally just being consistent and trusting the process, and it's guaranteed. As long as you don't just invest in Silicon Valley Bank or Lehman or Enron, and you're diversified and you're doing some smart investments and have smart people helping you, you will, I believe, have 7 figures at 70. And that was the last book I wrote, 7 figures at 70, because we all can do it. I'm going to write another book, actually. I haven't figured out what it's going to be, but I'm itching to do another one. It's been a couple of years. That's it. I hope you guys enjoyed the video. If you have questions, contact info is here. If you don't get me, trust me, the team, we have an amazing team at IRA Financial, and we really focus on training hours a day where we go through different scenarios and make sure we're all caught up and understand all the rules so we can properly advise you and give everyone who calls in or chats in for free accurate and concise information that will hopefully help you make the right choice and what is the best retirement plan for you and your business. If you are self-employed, the solo K is the best. Although if you are self-employed and have the potential to put away more than 76.5, 69 or 76.5, there's something called a combo cash balance plan. I'll do a masterclass on that. The thing is, I'm actually not a master at the combo cash balance plan. So I have a number of colleagues that I work with at pension investors who've been doing this for 40 years that will come on a video and teach you everything you need to know about the combo. But if you're happy doing between 0 and 76,500 deductions, you're self-employed, the solo plan is a great plan. But if you're itching to do more, the combo cash balance plan is an amazing plan, and I'll do a masterclass on that in the coming weeks, so you can educate yourself about that and understand how that works. That's it for today. Thank you for hanging out. Appreciate it. Have an amazing day. Take care.